All right, so let's talk some numbers. So pretty much the system that I basically run is a low risk, high reward system. And pretty much a rule that I've been starting to implement is a 60-30-10 rule. So these are very easy to implement, and but it does require a lot of discipline. So for the most part, anybody can basically use it and be active in it, because it doesn't really require a whole lot of income to really be active with it to get started. All it really requires, income wise, is for you to know how much you're willing to lose. And when I say how much you're willing to lose, I mean, you lose the money and it's not breaking you. It's gone and you're okay with it. So pretty much the whole thing is, once you get that figure in your head of how much you're willing to lose, um, in order to have a nice little cushion to implement the high reward, low risk, is to basically invest 300% above that amount that you're willing to lose. So the way that works is, let's say I'm willing to lose $50. So pretty much I would have to invest $166.67 to basically have that cushion of low risk, high reward. So from here, my goal would be to hit 60% profit, and I'm only willing to lose 30%, which puts me right at my $50 target that I'm only willing to lose. So let's say my first day I hit my target of 60% and I'm successful. I make $100 in profit because I hit my target. So now my new balance is $266.66. So guess what? From here, I'm pretty much going to do the same thing. I take out 166.67. I put that back into the market to invest. My rules never change. I'm only willing to lose 50. And I'm basically looking to exit at 60%, which gives me another $100 and brings my account to $366.66. So pretty much after my first trade, I still have $100 in the bank and I have 166 active. After my second trade, I still have $200 in the bank and I only have 166 active. So pretty much by my second trade, my initial 166 is completely secure. So I'm investing with what they call house money, which is pretty much the stock market's money.
Here, $1.
So, you just pretty much keep this plan in place and it should definitely be good for you. So let's do worst case scenario. Let's say you get in, you're profitable one day. So you make $100. Your balance is 266, but then your second day you get in and you lose, so you only lost 50, right? So of that 266, you're gonna do this number here minus 50. You still have 216.66 left. So pretty much you can take 166.67 from this balance, put it back into the market, and God forbid, let's say you lose another 50. Okay, so now we're gonna take that new balance, subtract another 50 from it, and look where you're at. You're pretty much right back where you started. So how much money did you really lose? You were profitable one trade and you lost two consecutive trades after, but you really didn't lose any money. So that's pretty much why this is, something that I say requires a lot of discipline, because the minute you deviate from it, you can really lose more money than you want to. So as long as you keep this plan in check, you're good to go. So let's say pretty much you were successful with 5 trades, right? So let's say you did this every day, each week for a whole year. So each week, pretty much you're collecting $500. And for that year, you're collecting $25,909.74. So from here, this is where I implement my 60-30-10 rule. So from this balance, I take 60% and I roll it over into long-term options, which is pretty much a 1 to 2 year hold. And then I take 30% of this same number and I roll it into stocks, that pay dividends, and I hold those for 5 to 10 years. And then 10% of this balance, I basically put right back into this intraday program. And pretty much all intraday stands for is same day trades. So pretty much if you keep those rules, you'll have diversity in different asset classes, and you won't have to, risk everything in one asset class. So if we go over to our options, a 2-year long-term options, 1 to 2 year holds, pretty much the 60% gives us this balance right here. So the good thing about long-term options is that the minimal return average for options is about 300%, but I did a worst case scenario and I said 250%. So and this is something that pretty much happens with your eyes closed. It doesn't really take you to be completely active to make this 250%. So let's say you start off with this balance here. By year number 2, you make the 250% goal. You get 38,000. So here's the beauty of it. You're still only risking 50% of your initial investment. So the rule doesn't change. The rule doesn't change. You will basically want to have your risk always lower than the amount of reward that you're expecting. So you do this year over year. Year 2, you made 38. You take 30% of this profit and you roll it over to your stocks. So pretty much you add that to this balance here, plus that dividend, and it gives you this new total for year number 2. So by year number 2, you have almost 20,000 in stock. You have almost 40,000 working for you in options, and you still have some intraday money going on over here. So that's the beauty of it. You just got a whole bunch of different things working for you from an initial $166. So that's the beauty of kind of keeping your rules, staying consistent, making sure you always get in at the low, exit at the high. Don't try to chase profits. That's why I say always get out at 60%, because profits can run. We've seen profits run over 1,000%. So if it hits 60%, go ahead and get out. That's the whole thing. You want to maintain consistency, because I'm gonna show you, when you maintain consistency. Because honestly, let's say by the time you get to year 2, you can really scrap the intraday trading if you wanted to, and you could just work off of these 2 asset classes: your long-term options and your long-term stocks. But let's say you wanted to continually be active in intraday, so you would take this new balance right here, which is 259997, and that would be the amount that you're willing to risk now. So pretty much it will require you to go ahead and invest 8,600. So once you get that 8,600 in here, you're doing the same thing that you were doing before with 166. And you can see how drastic the numbers changed, just because by year number 2, I decided to go ahead and implement and use that as my new risk. And pretty much, all this really is really buying the same stuff that you were buying, but just buying more of it. So instead of just buying one contract, you're buying 100 contracts. And pretty much you're, looking to get the same type of risk to reward. So you see, if you stay consistent, this 60% can go a long way, especially when you combine it with the 60-30-10 rule. And don't deviate, don't change. So just imagine 6 years down the line, you got $40 million in stock. You got $40 million in stock 6 years down the line. You got $202,000 in dividends getting paid to you every single year. And it doesn't even deduct out of that 40 million. This just comes just because you're invested in certain stocks. And then on top of that, you got another 79 million working for you in options, expecting to turn over 250%. So God forbid, you're still working intraday and you got all of these other asset classes working for you. You got 60% working for you here at 80 million. You got 30% working for you here at 40 million. God forbid you got the other 10% working over here in intraday. Consistency. That's all you need. Consistency and discipline. Do not deviate.
We should have a very happy new year.
Indeed.